Welcome to Secure Money Mindset, where seasoned advisors cover the topics that matter most to your financial future. Each episode is packed with practical insight, real conversations, and guidance you can trust. Let's dive in.
Hello, and welcome to the Secure Money Mindset podcast. I'm Isabelle.
And I'm Nate.
And today we're going to be diving into the stock market. In this episode, we're going to give you a beginner-friendly guide to the stock market and why working with an advisor can be very beneficial.
Yeah, we thought that it would be a really good resource to have. Maybe someone's new to investing, or this could also be a really great tool if your kids haven't invested before, or you have people who are just asking about the stock market in general. This could be a good resource for them just to kind of get their feet wet and maybe learn a few things that they haven't thought about before.
So if you are one of those people that has no idea what the stock market is, a simple definition is that the stock market is where people buy and sell ownership in companies called stocks.
Yeah, and in a relatable analogy, it's a big marketplace, but instead of food and clothes, you're buying tiny pieces of ownership in companies like Apple or Amazon or Microsoft, some of the big names. But yeah, you're essentially buying a piece of ownership in the company, and that's a really broad definition of what the stock market is.
So Nate, tell us why people invest.
A lot of people invest because they're looking for long-term growth. Stocks have historically outpaced inflation, which is why people have used it to save for retirement or a big dream, such as a retirement home, a beach home, their child's education, and stuff like that. So there are some perks to owning stocks as well. One of those is dividends. The company, when it makes money, sometimes gives people a piece of that. Not every company does, but it is something that is associated with stock ownership as well as a potential for growth in the long term.
Okay. So since you are investing, there does come with risks, I'm assuming. So what are the different risks? Are there different risk levels?
Yeah,
What's that?
That's really important, and talking with an advisor can help you with those because market volatility is normal. I don't know when exactly this podcast is going to come out, but we've seen over the past couple months in the beginning of 2025 a lot of market volatility, and that's just something that we come to expect when we're investing in equities. But there also are bonds, which we'll talk about in a little bit too, but there is a mix of stocks and bonds typically in a portfolio because someone who has a longer term time horizon, it might be willing to take on more risk because they have more time to meet their goals. Whereas somebody who has a shorter term time horizon, maybe 3 to 5 years, or somebody who needs liquidity from their money. So think of somebody who is retired or living on a fixed income. So there's different levels of risk that people are willing to take on, and that's just based on your goals.
And so there are different options when it comes to investing. And what are some of those different options?
So some of the different options for investing are stocks that we just talked about. So a little piece of ownership in the company. There are also bonds. Those are typically more stable investing instruments. A bond is debt in a company, and they will pay you interest for that. There's a lot of complexities to the bond market, but the short and sweet of it is that bonds are typically more stable than stocks, which is why you're going to see a mix of stocks and bonds in most portfolios. To go a level deeper than that, there are other things such as mutual funds and ETFs. These are baskets of stocks. And we have another podcast coming out that is going to be about the different risks of investing. So stay tuned for that. But to give you a little taste of that, mutual funds are a basket of stocks, and so are ETFs. So one of the risks of investing is not being diversified. You have, say you own Apple stock and Apple stock goes down by 10%. Well, if everything you have is an Apple, you've just gone down 10% rather than having it spread out across like an ETF that has 500 companies in it. So there are other instruments that allow you to have more diversification. And those could be a stock ETF, a bond ETF, and stuff like those. So there are a couple different other instruments, but just really trying to keep this at a really high level.
Yeah. And if you don't want to do it yourself, an advisor is a great option. If you don't want to DIY this, it's great to just talk to an advisor that can help tailor this plan directly for you.
Yeah, and an advisor can help you set realistic goals. I mean, you might have somebody who has a 3-year time horizon and they really want to take on a lot of risk. And an advisor might say, hey, maybe you want to temper that a little bit because you don't want to be really aggressive, and then 3 years down the road, it's bad timing. You got to take your money out to send your kids to college, or you are ready to retire and the stock market takes a dip and you're going to have to wait 6 months, or continue to take on more risk. So it's really important to have those conversations and understand what your risk level is and what your risk tolerance is, when you're talking about investing.
So for the person that is thinking about getting started in investing, let's kind of give them a step-by-step guide. And that first step, talking to a financial advisor.
Yeah, same thing I was just talking about. An advisor will help you understand your full picture. And, not every investment you have is going to have the same goal either. So some you might be invested in more stocks than bonds because, hey, maybe you're in your 20s and you're not going to retire for 40 years. But then you also might have another account where you want to take on a little bit less risk because you're planning on buying a house in the next 3 to 5 years. So those are conversations you can have to make sure that your risk levels are in line with your goals.
And that's how it ties into step number 2 is setting realistic goals, really thinking about what you're investing for.
Yeah. And step 3 is building a plan with guidance, not a piecemeal app-based approach. An advisor can offer more practical portfolio tips and can also help with taxes, timelines, emotions, and life changes. A lot of times when we're having discussions with clients, again, another recent example where we saw a lot of volatility, staying invested was the best thing people could have done because we've seen the stock market recover from that. So looking at your time horizon, and having somebody that you can call on and say, hey, I'm concerned about this, or I'm worried about this, or I don't understand this, because there is a lot of, this was such a high level intro, but there's a lot of stuff that is hard to understand. So having a conversation with somebody can really help. So as we've talked about today, stocks are small pieces of ownership in a company, and bond is debt in a company. There is potential for growth, and there is a way to have a balanced portfolio based on your individual goals. And yeah, the stock market's a great tool, but it's not one to navigate alone.
Yeah, so if you're ready to grow your wealth in a smart way, don't go at it alone. Partner with an advisor who can walk you through every step of the way.
Thanks for listening to this week's episode of the Secure Money Mindset, and stay tuned for a podcast about the risks of investing.
Yes. Bye.
See ya.
We hope you enjoyed today's episode of Secure Money Mindset. For more, search Secure Money Mindset on Spotify or wherever you listen to your podcasts, and watch full episodes on YouTube. Thanks for listening to Secure Money Mindset, where financial security is a state of mind.